Imagine this. You've settled in, popcorn ready, remote clutched, all set for the big game on YouTube TV, and instead of Fox Sports, boom, buffering screen.
Ugh, the worst.
Right. Meanwhile, over in the finance world, Nvidia's upcoming earnings report. It could single-handedly swing markets by, get this, an incredible $260 billion.
Wow.
And like something out of a political thriller, President Trump just tried to oust a Federal Reserve governor, sending gold prices, shining brighter than your aunt's heirloom jewelry.
Quite the mix of headlines.
Exactly. Welcome to the deep dive. Here, we don't just skim the surface. We cut through the noise, dig into the sources, and bring you the vital, actionable insights. We want those aha moments, the surprising facts that help you feel truly plugged in. Today, we're navigating a real whirlwind of market-moving events. You've got high-stakes tech fights, global political moves, sharp corporate strategies. Our mission: connect these seemingly separate dots, show you the underlying patterns impacting your world, and maybe, just maybe, uncover some compelling opportunities you might have missed.
Indeed. It's a truly fascinating moment, isn't it? Like a tapestry woven with threads of tech disruption, political gamesmanship, and big economic shifts. We're digging into everything, from those high-stakes negotiations in the streaming universe to the, seismic reverberations coming out of D.C. and across European capitals.
Right.
Then we'll pivot, look at the future of AI through the lens of a tech giant's huge earnings report. And before we wrap, we'll delve into two pretty distinct, but I think equally compelling bullish investment cases.
Sounds good.
What's really captivating is how these different headlines are actually intricately linked. They reveal these deeper patterns that will undoubtedly shape, your financial landscape and the decisions you make. So let's start unspooling these threads, see what stands out as we kick off this deep dive.
Okay, let's start with that battle for your screen time. The big streaming showdown, Google-owned YouTube TV versus Fox Corporation.
Right, the retransmission fight.
Exactly. Right now, these two giants are locked horns in a negotiation that could genuinely see channels like the Fox Broadcast Network, Fox News, Fox Sports just go dark. For millions of subscribers.
Millions.
We're talking a very real looming blackout. And the deadline for this whole contract dispute is set for Wednesday evening, August 27th, 2025, specifically 5 p.m. Eastern.
Okay, so that's coming up fast.
Super fast, which means a lot of sports fans, news watchers, they could be looking at a blank screen pretty soon.
So the obvious question is, why? What's the real sticking point here? At its heart, this is a classic power struggle, right? It's about perceived value, distribution leverage. Especially in this messy, fragmented media world we're in now. YouTube's position, and they've been pretty clear, is that Fox is demanding, quote, far higher payments than other partners who offer, comparable content. They're framing it as protecting you, the subscriber. They want a deal that reflects market value without passing on what they see as inflated costs.
Okay, so that's Google's side.
Yeah. Fox, though, they shot back fast, expressing, quote, disappointment that Google continually exploits its outsized influence by proposing terms that are out of step with the marketplace.
So it's not just a little disagreement over a few cents. It's a fundamental clash over who holds the power now.
Right. The distributors versus the content creators.
Exactly. For decades, broadcasters held the cards. Now, distributors like YouTube TV with these massive subscriber bases, they're flexing their muscles. They think their reach is just as valuable, maybe more so, than the content itself.
And both sides are digging in their heels.
Totally. Each convinced their assessment, their leverage is the right one. It's classic high-stakes negotiation. And look, this kind of fight isn't totally new. We saw it when cable started unbundling.
Sure.
But it's gotten way more intense in the streaming era.
So this is where it really hits home for you, the viewer, right? If these channels do go dark, millions of people, people who've cut the cord, rely only on YouTube TV for Fox stuff, especially sports, local news, maybe their daily political fix. They're directly affected. There's no doubt.
Yeah.
Now, YouTube TV, they're obviously anticipating some backlash. They're trying to soften the blow a bit. They're offering that $10 credit to members if Fox goes offline for an extended period, which, let's be honest.
Yeah, $10 when you miss the game probably doesn't feel like much.
Right. And they've also suggested, hey, users could just sign up for Fox One, which is Fox's own streaming service. But does that really solve the problem for millions? Or is it just, a Band-Aid on a bigger industry issue?
Well, stepping back for a sec, this dispute, it really is more than just a temporary tiff between two big companies. It's kind of emblematic of this broader systemic shift.
Right.
It's really a continuation of these high-stakes contract battles we've seen more and more as consumers, like you, ditch traditional cable for streaming.
Like the Paramount thing earlier this year. It's exactly like the Paramount Global situation with YouTube TV back in February. That got resolved, thankfully, but it showed the same underlying tensions. And these power struggles, they have huge implications, not just for you trying to watch something, but for advertisers too. They rely on these platforms for reach.
Right, eyeballs matter.
Hugely. And the stakes are incredibly high, especially when you look at YouTube TV scale. They recently overtook Netflix in audience engagement time, which is huge. And they boast this massive subscriber base. The CEO said over 8 million back in February 24. Some analysts think it's closer to 9.4 million paying subscribers now.
That's a significant chunk of viewers.
It absolutely is. If a blackout happens, those millions of eyeballs, they go somewhere else, or maybe they just turn off. So this isn't just about a temporary inconvenience. It's really about the evolving economics of streaming, right? It's about the value content creators put on their stuff and how these powerful companies fight tooth and nail for your monthly subscription dollars.
It really speaks volumes about the shifting power dynamics.
Totally. The lines between making content and delivering it are blurring, and every single subscription dollar is fiercely contested.
Okay, so from the battle for content, let's pivot to a different kind of power struggle. One that sent immediate tremors through the financial markets, a political earthquake coming out of D.C.
Ah, yes. The Fed situation.
Right. On the political front, we saw a pretty significant and frankly kind of audacious move from President Trump. He attempted to oust Federal Reserve Governor Lisa Cook.
Yeah, that was unexpected.
He announced it on Truth Social late Monday, citing these serious allegations of mortgage fraud against Cook as the reason. It's a bold play, immediately grabbed the market's attention, raised serious questions about the independence of the Fed.
And that move immediately puts the Fed's independence, its stability, right under the microscope. I mean, this is an institution seen as a cornerstone of global economic policy. Lisa Cook, for her part, she's been very clear, vowing not to resign, strongly disputing the president even has the authority to fire her. And it's important to remember, right? Presidents trying to influence or pressure the Fed for lower rates.
Yeah.
That's not new. Trump did it repeatedly, though mostly unsuccessfully, before.
Sure.
The real concern here, though, is if he somehow did succeed in removing Cook, that opens the door for him to nominate someone new. Potentially, he could secure a 4-person majority on that 7-member board.
Yeah.
And that would be a truly significant, maybe unprecedented shift in monetary policy power.
A big shift.
Huge. As Andrew Ticehurst at No More Australia put it, this just reminds everyone, the U.S. administration remains unconventional and unpredictable. It really highlights that delicate, often tense balance between politics and the Fed's independence, a balance that, historically is tilted toward independence for market stability.
And the market's reaction, it was fast and pretty telling. Gold prices, the classic safe haven asset, immediately rose 0.20%. GCF is the ticker.
Right. Flight to safety, or maybe something more.
Maybe something more. It felt like a signal of growing skepticism about the Fed's autonomy long term. Investors may be pricing in a future where politics dilutes policy effectiveness, pushing them towards alternatives like gold.
Makes sense.
At the same time, the dollar fell against major peers. It trimmed some losses later as Cook pushed back, but still. And we know a weaker dollar often helps gold.
Sure.
Long-dated U.S. Treasuries also took a hit. Prices fell, meaning the yield on 30-year bonds went up.
And higher yields mean?
Higher yields reflect investor concern, right? More uncertainty, potential for more inflation down the line, so markets demand more compensation for holding U.S. debt during political volatility.
So if we step back and look at the bigger picture, the bond market reaction especially, it signals investors are getting more worried that Trump's attacks on the Fed, his lobbying for lower rates, it could actually fuel inflation.
The opposite of what the Fed usually tries to do.
It's exactly. Charu Chana at Saxo Capital Markets pointed out that for gold, this situation gives it double support. It benefits from rising rate cut expectations, but also from investors hedging against longer-term inflation and, institutional risks. The fear for some is that the Fed board gets, quote, stacked with doves. Policymakers more inclined to lower borrowing costs, even if inflation picks up. And if that happens, investors will demand more compensation to hold U.S. debt, right? A buffer against higher inflation.
But there are checks and balances, presumably.
Well, yeah. Paul Donovan at UBS Global Wealth Management offered a counterpoint. He reminded us there are checks, like Senate confirmation for any successors and the policy votes from regional Fed presidents. They might limit the negative market reaction over time. The Fed's a complex beast, designed for some resilience. But Sarah Binder, a political science professor at George Washington University, she put it pretty starkly. The Fed needs defenders, especially bond traders. Yeah, underscoring just how critical market confidence is for the Fed's credibility and the whole financial system stability. Any perceived threat to that independence, real or just threatened, has immediate, tangible effects across assets.
So what does all this political drama mean for interest rates? The rates that hit everything from mortgages to credit cards, business borrowing costs.
Right. The bottom line for many people.
Well, the central bank has actually held policy steady so far in 2025, mostly because of concerns that Trump's tariffs, potential trade wars, could actually fuel inflation, kind of canceling out reasons to cut.
Interesting tension there.
Yeah. But Fed Chair Jerome Powell at Jackson Hole last week, he did signal a potential adjustment in September. He suggested a rate cut might be needed to support the job market if the economy allowed it.
Okay, so a hint of a cut.
A hint. And adding to that, New York Fed President John Williams said just Monday that the era of low neutral interest rates appears far from over, implying there's still room to go down without overheating things.
So traders are probably pricing that in.
They are. Traders are currently pricing in a 25 basis point cut for September. But here's the big but. The data point that could change everything. U.S. personal consumption expenditures, PCE data, due this Friday.
Ah, the Fed's preferred inflation gauge.
Exactly. And this data, especially core PCE, excluding food and energy, is expected to show the fastest annual pace of acceleration in 5 years.
Oof, that would complicate things.
Massively. Such a strong inflation number would likely limit the Fed's ability or maybe willingness to lower rates. It creates this fascinating tension between market hopes and economic reality, forcing a tough balancing act.
And this whole political and monetary tightrope walk, it also connects to those simmering tensions over the U.S. budget deficit, right?
Definitely. Remember, the House just passed that huge $3.4 trillion fiscal package. It cuts taxes, curtails spending on safety net programs.
A massive piece of legislation.
Huge. And it could potentially add to the national debt, which is already a sensitive point. The long-term impact, especially if it's not matched by revenue increases or other cuts, that can influence how investors feel about U.S. Treasuries.
So keep an eye on the Treasury auctions this week.
Absolutely. Traders will be watching this week's auctions 5- and 7-year notes very closely to gauge market appetite. Strong demand signals confidence. Weak demand could push yields higher.
So the takeaway is this isn't just D.C. political drama.
Not at all. It directly impacts the value of your investments, your borrowing costs, safe haven assets like gold, and it gives us crucial hints about where the whole U.S. economy might be heading. It's this complex, interconnected web of fiscal and monetary forces.
Everything's connected.
Always. Okay, let's shift gears again. Our next big tremor, coming straight from the tech world. All eyes are glued on Nvidia this week, and for very, very good reason.
AI king.
The AI king indeed. Options traders are pricing in about a $260 billion swing in Nvidia's market value after its Q2 earnings report. That comes out after the market closes on Wednesday, August 27th.
$260 billion swing.
Yeah.
Just process that number.
It's staggering. That's roughly a 6% move up or down for the shares. Now, interestingly, that implied move is actually a bit smaller than their long-term average.
What does that suggest?
Well, it might suggest investors feel they have a slightly better handle on what to expect this time, but let's be crystal clear. The stakes are still incredibly, incredibly high for the company that's basically defined the AI hardware boom.
Yeah, no kidding. And zooming out, these earnings, they're not just about Nvidia, are they?
Not at all.
They're going to be a major catalyst for U.S. stocks generally, and a really crucial test for that whole broader AI trade that's been driving so much market enthusiasm and, frankly, valuation expansion.
Good point.
Like Chris Murphy at Susquehanna said, the ripples out of Nvidia might be more interesting than the actual move for Nvidia. We've seen a lot of those speculative AI names pull back recently, right? Correcting from maybe overheated highs. But Nvidia itself, still hanging out near its all-time high, leader of the pack.
Which puts immense pressure on these results.
Absolutely. Traders are scrutinizing these numbers. Is that staggering $4 trillion market cap really justified by performance and, crucially, the forward outlook? This is kind of a moment of truth for the whole AI investment thesis. Can demand for these chips really sustain this pace, the insights from this report, they'll ripple through the entire tech sector, suppliers, cloud giants, everyone invested in AI.
Now, here's where the plot really thickens. It's super intricate. Nvidia's business in China, that's a huge focus for investors. It's like a geopolitical tightrope walk.
Yeah, the China piece is critical.
You've got the ongoing U.S.-China trade war, the constant tariff talk, those chip trade curbs. They create these significant headwinds. And we just learned Nvidia recently agreed to pay the U.S. government 15% of its China sales just to get export licenses, a move that kind of weirdly drew criticism from both parties in the U.S.
Caught in the middle.
Totally.
Right.
It's this delicate dance between national security interests of two superpowers and Nvidia's own business needs. It's not just sales, it's about strategic agility in this splitting tech world.
And what's really fascinating is the two-sided impact of this geopolitical tug of war. It creates this uniquely tough operating environment. Because despite China's massive appetite for Nvidia's advanced chips, they need them for their own AI ambitions. Beijing has been actively telling domestic companies to limit purchases, citing security concerns, wanting to boost their own chip industry.
Right, the push for self-sufficiency.
Exactly. Then making it even harder, there were reports Nvidia told suppliers to pause production of its China Special H20 chips, the one that's designed to meet earlier U.S. rules.
Okay, so pulling back.
But wait. In a fascinating twist, Reuters also reported Nvidia is already developing a new, even more powerful chip just for China.
Whoa, so they're still playing the game.
Looks like it. A sophisticated long-term strategy to navigate the restrictions. This constant back and forth, this push and pull, it directly hits Nvidia's revenue forecasts, its product roadmap. Jimmy Myers, an analyst at Nvidia shareholder Laffer Tengler Investments, really nailed it. He stressed the need for clarity, asking, essentially, does China even want the chips? Will the U.S. admin allow it? And if so, how does that actually work?
Yeah, a lot of question mark.
It's a super complex, shifting landscape. Engineering brilliance has to constantly deal with political realities.
So let's talk bottom line. What does this mean for Nvidia's financials, the numbers that drive the stock? Well, the U.S. curbs have already hit hard. They shaved $8 billion off Q2 sales guidance, led to a $4.5 billion charge last quarter.
Ouch. Tangible impact.
Big time. And for this current Q2, analysts didn't even factor in H20 sales revenue because the U.S. approval came so late. Any revenue from those gets pushed out.
Got it.
Looking ahead, that federal deal, the 15% payment on China sales that could hit gross margins by 5 to 15 percentage points just on those China-bound chips.
Significant margin pressure.
Yeah. Bernstein analysts think it could cut about 1 point from Nvidia's overall gross margins. That's not trivial for a company known for high profitability. It just shows how geopolitics, no matter how innovative you are, can directly translate into financial hits and strategic headaches for global companies on the cutting edge. Managing these external pressures is almost as crucial as the tech itself now.
Right. But overall, despite these headwinds, despite the intense scrutiny, Nvidia is still expected to report some truly impressive numbers for Q2. Revenues projected to jump, what, 53.2% to $46.02 billion, according to LSEG data.
Still huge growth.
Definitely strong. But, it is a far cry from the triple-digit growth they saw before. It signals a maturing market, maybe, albeit one still expanding rapidly.
And margins are expected to dip.
Yeah, adjusted gross margin expected down nearly 4 points to 72.1% for Q2, and likely contracting more in the October quarter, mostly due to those China costs and a changing product mix. But here's the key thing, I think, for the long-term bull case. Analysts pretty much agree the overall AI chip business is still absolutely booming.
Demand isn't slowing down.
Doesn't seem like it. Robust demand keeps pouring in from giants like Meta, Microsoft. They're both hugely expanding their spending on AI infrastructure, language models. And look at the stock. Nvidia shares are up over 34% so far in 2025, crushing the broader chip index, crushing the S&P 500.
Still leading the market.
Big time. For Q3, analysts are looking for revenue guidance around $52.96 billion. That's up 51% year over year. And maybe about $6 billion of that could come from China, if those new chips work out and the regulators play ball. As Matt Amberson at ORATS put it, it's just a Goldilocks time for Nvidia, like a sweet spot of strong demand and market position.
So the takeaway here is Nvidia's performance is like a pulse check for the whole AI industry.
Exactly. It impacts tech stock valuations, maybe the direction of innovation, global tech leadership. It's a true bellwether for AI's future. The real insight, I think, for long-term investors is watching how effectively they pivot that China strategy, dealing with curbs, developing new chips to stay on top amidst this rising tech nationalism.
Okay, let's shift our gaze across the Atlantic now. Political instability seems to be making waves over there too, and not the good kind.
France. Yes.
Prime Minister Francois Bayrou has called a confidence vote, and it could actually topple France's government maybe as soon as next month.
That's a big deal for European stability.
Yeah, huge deal. France is central, right? A pillar of the Eurozone, big economic influence. This kind of uncertainty, it tends to ripple outwards.
And what's really striking this time is the unusual alignment of the opposition parties. It signals a pretty significant challenge to the government's ability to even govern.
Who's lined up against him?
You've got the far-right National Rally, the leftist France Unbowed, the Greens. They've all said publicly they'll vote against the September 8 motion. Even the socialists, who sometimes play ball with the center, said they wouldn't back the government this time.
So the implication's pretty stark.
Totally. If a majority votes against Bayrou, constitutionally, he has to submit his government's resignation. That means major political upheaval, maybe a snap election.
Which begs the question, why take such a massive risk?
Right. Bayrou himself addressed it. He told reporters, yes, it's a risk, but the supreme risk is doing nothing. There's no getting out of this situation if we are not brave. He basically believes inaction, given the challenges France faces, is a bigger threat than facing down the opposition, even if it costs him his job. The policies he's pushing, budget austerity, economic reforms, they're deeply unpopular with different groups, so he needs this high-stakes gamble to try and solidify his mandate.
And this isn't just a one-off thing, is it? It feels like part of a pattern of political fragility there.
It really does. A failure here would just underscore how tenuous President Macron's position is. Remember, his centrist party and allies lost their parliamentary majority back in 2024.
Right, no clear majority.
Which has forced his governments to constantly scramble for unstable coalitions or use executive decrees, often fueling public anger. And look at the turnover his previous PM, Michel Barnier, lasted only 90 days.
90 days, wow.
Yeah, it's a testament to the political headwinds. So this isn't just one government on the edge. It reflects this deeper, ongoing political fragility in a major European power.
And Marine Le Pen's National Rally is waiting in the wings.
Exactly. They're now the largest single party in the lower house. They're already calling loudly for a new election, eager to capitalize on any instability and build on their growing influence. A shift like that could really alter the European political map.
So zooming out to the economic impact, what are investors doing?
Well, they're clearly hedging. Hedging for more political uncertainty across Europe, and that's led to a noticeable sell-off in French assets. The yield on 10-year French debt rose 9 basis points Monday to 3.51%. That led global bond market losses. It's a clear signal of shifting risk perception.
And the spread over German bonds.
Even more telling, France's borrowing premium over Germany, that key indicator of perceived risk within the Eurozone, widened 5 basis points to 75 basis points, highest since April. And here's the really surprising part, maybe concerning. That gap is now wider than countries like Greece and Portugal, which were at the heart of the sovereign debt crisis years ago.
Wow. That's a significant shift in perception.
Huge reevaluation of French fiscal stability and a Barclays basket of stocks, the ones most exposed to French domestic risks, government budget, consumer mood that dropped 2.9% Monday. Immediate market nerves. Vincent Juvens at ING in Brussels summed it up pretty starkly. He said, it's a two-tier Europe we have now. Some countries like Germany that can afford to spend on growth and those who have no choice but to consolidate their public finances.
So domestic politics in France directly hit investor confidence.
Impact sovereign debt, making French bonds less attractive, affect the Eurozone's health, maybe international trade, the euro, your investment decisions. It just shows how local political fights in a major economy can have these far-reaching global financial consequences.
Okay, after navigating all those turbulent macro waves, streaming wars, Fed drama, Nvidia's ups and downs, French politics, it's easy to feel a bit overwhelmed, right?
Definitely a lot swirling around.
But it's often in these times of uncertainty that specific, well-run companies can really stand out. So let's shift gears, dive into maybe a couple of distinct investment opportunities that could offer some compelling returns despite all this global noise.
Sounds good. Looking for diamonds in the rough.
Exactly. Our deep dive first uncovered a bullish thesis on Casey's General Stores, ticker Casey's Y. They've got this really distinctive business model, strong, consistent growth.
Casey's, yeah, they're interesting.
They operate about 2,900 locations. That makes them the third largest convenience store chain in the U.S. by store count. But here's the kicker. the surprise that really speaks to their strategy.
The pizza.
The pizza. They're also the fifth largest pizza chain in the country. It's this unique blend of convenience, fuel, and quick service food that really sets them apart from your typical gas and go.
And what's really fascinating is that unique strategy, right?
Yeah.
It goes way beyond the usual C-store playbook. Casey's really differentiates itself by focusing heavily on fresh food offerings,
Yeah.
actively moving beyond just gas and smokes.
Right, the sandwiches, baked goods.
And the pizza, their famous, almost cult favorite pizza. This pivot to fresh food, it's enhanced the customer experience, sure, but crucially, it boosts profitability.
Higher margins than gas.
Often, yes.
Yeah.
Much higher margins than fuel sales.
Yeah.
Makes it a powerful driver of their overall financials. And they keep adding stuff, like new chicken wing flavors. Points to ongoing sales growth potential in that high margin area.
But how do they pull it off consistently? C-stores usually have high turnover.
That's the important question. And a standout strength, often overlooked, is their employee retention. Casey's employs roughly 40% more staff per store than the industry norm.
40% more.
Yeah.
Oh.
It fosters this loyal, well-trained, community-focused vibe, especially in the rural areas where they have a big presence. This investment in people creates a stable workforce, which translates directly into consistent service, better product quality, stronger local customer connections. It's a real competitive moat. Their transaction counts, basket sizes, they really back up this differentiated model.
So what does this mean for future growth, for the investment case?
Well, Casey's has this demonstrated, very effective expansion strategy. It's consistently supported by what they call accretive M&A.
Meaning the acquisitions immediately boost earnings.
Exactly. Rather than diluting earnings per share. It's a sign of smart capital allocation. That recent acquisition of 200 stores from Fikes, great example, boosted their footprint, market share.
And they see more room to grow.
They do. They see ongoing potential for significant unit growth, especially targeting high opportunity, maybe underserved markets like Texas, where they can replicate that community-focused model.
And the stock performance reflects this.
Seems so. The stock's already up about 30% this year alone. Clear sign of investor recognition of their unique position, their management's execution. Trading around $507.84 as of August 15th. Their trailing and forward PE ratios, around 34.7 and 31.7 respectively, they suggest continued confidence that management can keep delivering long-term growth, maintain those high operational standards.
So consistent same-store sales, strong cash flow, disciplined expansion.
Yeah, paints a compelling picture. A company with a clear path, solid financials, and that surprisingly diversified revenue stream beyond just the gas pumps.
Okay, let's turn our attention to another interesting opportunity. This one's in luxury hospitality and gaming. Wynn Resorts, ticker WYNN.
Win. A different kind of play.
Definitely. The bullish case here really focuses on its premium brand, those ambitious growth plans in the UAE, and the significant upsides still potentially left for Macau's recovery. It's a bet on global luxury travel, discretionary spending, a rebound in the high-end market.
And zooming out on strategy, a huge growth driver is that UAE expansion, right? It's groundbreaking. They're developing their first casino in the UAE, Wynn Al Marjan, through a joint venture. It's a major entry into a totally new, high-growth market for these integrated resorts.
And the scale is massive.
Absolutely massive. Over 1,500 rooms, huge gaming facilities for both mass market and VIPs, premium dining, luxury shops, big entertainment program. It's strategically positioned to pull in a diverse crowd. Wealthy Dubai residents, vacationers heading to Ras Al Khaimah, high-net-worth international tourists looking for top-tier entertainment in a new spot.
And it's on track.
On track to open early 2027. And what's really fascinating from an investment view is that current market valuations seem to assign almost no value to this huge future project.
Really, zero value.
Minimal, if any. It suggests there could be significant upside potential once this growth catalyst really clicks into place for the market. Analysts think this project alone could add hundreds of millions in EBITDA within a few years of opening that's not currently baked into the stock price.
So the market might be overlooking a big future driver.
It happens. Sometimes the market misses these clear, defined future growth stories.
Now, here's where it gets really interesting on the valuation side, maybe offering that compelling risk reward. Wynn also benefits massively from its Macau operations.
Macau, still the big engine.
Right, but gaming revenues there are still lagging below pre-pandemic levels.
Yeah, the recovery's been slower than some hoped.
And that lag, combined with broader market jitters during the pandemic, it's created historically low valuations for Wynn relative to its long-term earnings power.
Okay, so potentially undervalued based on history.
Potentially. But recent data shows strong signs of improvement. June's gross gaming revenues in Macau, up double digits year over year. That signals a clear pickup in Chinese tourism, a rebound in discretionary spending.
Positive signals, definitely.
All point towards a robust recovery underway in Macau. Suggests that underlying demand for luxury gaming, high-end entertainment, it's steadily coming back. As travel gets easier, consumer confidence grows there, there's strong potential for Wynn's Macau revenues to climb back to, maybe even beat, previous peaks. That provides a huge potential tailwind that might not be fully priced in yet.
Indeed. So Wynn Resorts was trading around $109.45 as of August 15th, trailing PE around 32.4, forward PE around 24.3. You combine what were really trough valuations when maybe purchased, alongside these underappreciated growth projects like Wynn Al Marjan, plus that strong recovery potential in Macau. It really supports a multi-year upside case.
How much upside?
Well, some analysts suggest there's compelling potential for the stock to even double over the next 5 years, driven by this combo.
Double. Wow.
Yeah. And beyond just PE, if you look at metrics like enterprise value to EBITDA or free cash flow yield, they also suggest an attractive entry point. Plus, there's another angle, often overlooked. Wynn's portfolio of just top-tier, 5-star resorts and their pretty clean balance sheet. That could make the company incredibly attractive to strategic acquirers in the luxury gaming and hospitality space.
The M&A angle.
Right. That potential for M&A adds another layer of optionality, potential upside for shareholders. It just shows how careful, deep analysis can uncover businesses with compelling strategies, significant growth potential, even when the market's choppy and maybe not fully pricing in that potential yet. It's a play on both value and catalyst.
Wow, what a deep dive today, seriously. We've navigated everything from that intense battle for your streaming dollars with YouTube TV and Fox.
Right, the screen wars.
To the high-stakes political chess match shaking up global finance with Trump's moves on the Fed.
Big ripples from that one.
Yeah.
Then we jumped into the high-stakes game of AI chips, with Nvidia's huge earnings looming. Explored the fallout from political instability over in France.
Yeah, Europe's got its own challenges.
And finally, we unearthed those two unique investment ideas. Casey's General Stores, the convenience king with a surprise pizza empire.
And Wynn Resorts, betting big on luxury and that Macau comeback.
Quite the journey.
Indeed. And what's truly fascinating when you step back is how these seemingly separate events are actually deeply interconnected threads in this larger tapestry. Each one influences the next.
How so?
Well, think about it. The soaring global demand for AI chips, the geopolitical tension around making and selling them, that directly impacts international trade, who leads in tech supremacy. Political decisions in D.C., like listening with the Fed, they ripple straight through bond yields in your portfolio, affect global interest rate outlooks, even your streaming choices. Right. Seems like a simple consumer thing.
Yeah.
But it reflects this fundamental shift in the entire media economy away from cable towards on-demand. And that impacts advertising, how content gets valued.
It really forces you to see the connections.
Exactly. Understanding these connections helps you move beyond just reacting to the daily headlines. It empowers you to maybe anticipate the broader, more impactful trends shaping our world, from economics to markets to politics.
Absolutely. So as we continue to navigate this world of constant shifts, from streaming wars hitting your living room to geopolitical tremors shaking global markets, maybe the question for you, the listener, is, what unseen connections are you observing in your own environment?
Good question.
And how might those connections signal the next big shift, whether it's in technology, politics, or the market itself? Something to think about. Thank you for joining us on this deep dive.